This video is unique in that you could have skipped all of the previous videos and just come to this. For those people who say, just tell me what to do, I don't need to understand the underlying investment theory or strategy, just what should I do, what's simple, and this video will do that. What we want to do here is talk about mutual fund companies, how you find a mutual fund company you can use. There's one in particular I really like that will save you a lot of time, but lets you know what you can do there. We'll talk some about target funds, how important they are and how they can really streamline your process. But then two caveats for target funds. One is the lack of commodities or anything that's protecting from inflation risk. And then also, I don't like what target funds do for young investors. So those are the two caveats for target funds. But I do like target funds. They do make life much simpler for the typical retail investor who does not have a lot of time to mess with investing for retirement. Then if you want to do exchange traded funds, you'll need a brokerage account. I'll quickly show you how to do that. And then a little bit of discussion about dollar cost averaging. So if you're going to find a mutual fund company, you simply need to find a company you know and trust. I can't here tell you which fund family is the best. So what you want to focus in on is the size of the firm by looking at something that's called assets under management, or AUM. A large number means the firm is substantial in size and therefore they can spread their expenses over more investing dollars and more investors. So hopefully they'll be a very efficient firm for you, and also probably much safer and more reliable just from the standpoint that they are very large and have substantial resources. Here's Vanguard. Vanguard is a firm I do highly encourage people to check out. I won't say I recommend them, but they are a firm that has a couple of very big advantages. First, they're owned by their investors. They're not owned by the stockholders. They don't have stockholders. So they're owned by those people who invest with them, which means they only have one audience, and that is the people who are investing their money at Vanguard for retirement or for college savings. They don't have stockholders to have to answer to. That means they have no conflicts of interest, no competing priorities. They can focus in on their customers. There are other firms that are like that. I worked at USAA. They are somewhat like that, although they have outsourced their investment side somewhat. So that's something to consider. Vanguard has another big advantage in that they're a big index provider. They do a lot of passive investing. So they have very large funds, but very, very low fees. They're very trustworthy. I've used Vanguard quite a bit in the past as an institutional investor, investing hundreds of millions of dollars with them. They always have been very customer focused, and so I do like them from that standpoint. Their website is just vanguard.com, very simple. And when you go in, it is very, very simple. There will be buttons that show you how to open an account. You can actually see it here, open an account. You set that up to ask what kind of account do you want. If you're a taxable account investor, you'll set that up. If you can set up a Roth IRA or traditional IRA, they'll walk you through that. But they will do all the work for you, including funding the account. You can give them your checking information, checking account information, and they will pull the money from your account. Very simple. You can do it in just a few clicks. It does not take that much time to do. There are very many other investment firms. If you're not sure, you cannot go wrong with Vanguard, at least based on their history. My concern with Vanguard is how large they are. They're becoming an $8, $9, $10 trillion firm in assets under management. I do have concerns when firms get extremely large. They do tend to lose focus and start doing things that are not in their investors' best interests. So far, Vanguard has not shown signs of doing that, but you always want to watch out for that. There's no easy way to figure out who is the best manager to hire, to put your trust into, though I will say Vanguard has a great reputation. And I'm not the only one who says that. I listen to many, many podcasts in finance. Vanguard comes up frequently and always in a very positive light, including very complimentary comments from people you could consider Vanguard's competitors. So from that standpoint, I'm not recommending Vanguard, but I don't think you would be disappointed if you went with them. If you go into Vanguard, you'll see their asset classes. Here you can see one of their funds is VFIAX. That is a large cap blend. Blend, what they mean is it's balanced between growth companies and value companies. You can see they have an international fund, VAGVX, but it's a value fund. They also have an international fund that is a growth fund. So the things we talked about, large cap value, large cap growth, small cap value, international. They break up international between growth and value. All of those terms I talked about before, they will have that. You'll notice they have a list over on the left of the type of assets. So you see asset class, that will be what we did in previous videos where we talked about the large cap, the long-term bonds, all of those type of things. So you can certainly see different ways of categorizing their mutual funds. I usually click on asset class or strategies, and I'll show you why that's the case. And you can see once you get in here and decide what you're going to do, they have a button that allows you to go ahead and purchase the particular fund. You can see also that their expense ratios are very, very low. When you click on strategies, they have something called all-in-one. Here they show some strategies. I'm going to show you their target funds here in a second. They have what they call a conservative growth fund. The other thing you'll see are what we call target retirement funds. These are probably the most popular new strategy in the last 10 years. I created several of these for my 401k plan that I managed and for an investment firm I worked for. So I have a lot of experience with these. You can see they have a date, a year in them, 2020, 2025. What they mean by that date is that's the date you plan to retire. So if you plan to retire in 2070, if you're a very young person, so today maybe you're 20 years old and you expect to retire when you're 65, that may still not be quite 2070, but you're getting close, then you could just pick that particular fund. If you're retiring in 2068, you could probably just go with the 2070 fund. If you're retiring in 2063, you could probably just go with the 2065. You could actually put part of your money in the 2065 and just balance it. If you're retiring in 2062, you would put 60% of your money in the 2060 and 40% in the 2065. The wonderful thing about these funds is that if you're retiring in 2040 or 2050, let's say you're retiring in 2050, you can just put 100% of your money in the 2050. You do not have to worry about diversification because these funds are already very well diversified. They're a one-stop place that you can go. It's true financial planners will tell you, no, come to us, we'll help you with this. Their solutions will be very similar to what these target funds are doing, but you'll pay a whole lot more money to get the exact same thing. And what they do in these funds is as you move out in retirement years, they greatly increase the stock allocation. But over time, as you go through time, let's say we go another 5 years from now, 10 years from now, 20 years from now, the 2070 fund, as time passes, they will reduce the stock allocation so that when you get really close to 2070, you may not have 90% in stocks, you may only have 20 or 30% in stocks. That's just the nature of these funds. And that's the other big advantage of these funds is they do what we'll talk about in the last video, which is rebalancing. They rebalance for you. They move your stock portfolio and your bond portfolio to the right allocation as you get closer to retirement. So it essentially is an invest it, forget about it, pick a good company. And you can see their fees, this over here, 0.08% or 8 basis points is very, very, very low. So it's an all-in-one place to shop with a very highly respected company where you don't have to do anything except for just set it up. And you might want to, we'll talk about dollar cost averaging. I can mention it somewhat here. If you can invest $500 a month or $1,000 a month, you can set it up with them so that this automatically comes out of your paycheck every month or every 2 weeks, however you set it up, so that you're automatically investing for retirement. And as you get raises, you increase the amount you're allocating. That's called dollar cost averaging, where you're investing over time as markets move up and down. Here's two other funds, the 2020 fund and the 2070 fund. You can look at the 2020 fund. It's 42% stocks and it's about 58% bonds. So it's majority bonds. Typically a 2020 fund, someone who's already in retirement, will be anywhere from 30 to 45% in stocks and the remainder in bonds. Here's where I disagree with Vanguard and most target funds. For the 2070 fund, they have 90% in stocks and 10% in bonds. I strongly disagree with that for this reason. It looks like you have 90% in stocks, but in reality, while the dollar allocation is 90% stocks, but the risk allocation is almost 100% stocks. And the reason for that is that stocks are far more risky than bonds. So when you have 90% in stocks, because they're far riskier than bonds, they're going to dominate the risk of your portfolio. What I like to say, in a year like 2008 or 2020, when markets are down 20, 30, 40%, most people don't come out of a year like that and say, wow, I'm sure glad I had 10% in bonds. I lost 35%, but I could have lost 37% if I didn't have that 10% in bonds. People don't notice the risk reduction of bonds in a year like 2008 or 2020. Their portfolio is down so much. If you lose 35% versus 37%, you don't really notice that. However, in a strong up market, you will definitely notice your bonds lagging. That 10% in bonds, they're only up 3 or 4%, and your stock portfolio is up 30%. You're disappointed. I do have a blog on this that you can read, how young investors to invest. I recommend either just stick 100% in stocks until you're about 30 or so, or do 90% in stocks and do something much more radical with that 10%. I mentioned commodities. Commodities might not be a bad way to spend that other 10%. I'll talk about that more here in a minute. Or maybe 10% is in some stocks you think might really take over the market. Maybe you have 10% of your portfolio you're going to put in maybe 0.5% or 1% in 10 or 20 stocks, and you're hoping to find the next Microsoft or the next Apple. The wonderful thing about that, you see a new startup company you're interested in. If they work out, they could become the next Microsoft. If they don't, maybe they go out of business. But the wonderful thing is, if you buy 20 stocks and 19 of them go insolvent, but one of them is the next Microsoft, you still make a fortune. You can lose 100% on 19 of the stocks, but one of them be the next Microsoft or Apple, and your portfolio will make a lot of money in that 10%. So that's another strategy. If you have time to go and look for these startup companies, read my blog if you're interested in that. Young investors, though, I do not think putting 10% in bonds is going to do anything for your risk allocation. I don't think you're going to notice it. If you look at Fidelity, this is Fidelity on the left. You can see they also have target date funds all the way up to 2065, probably very similar. They have index funds the same way. They have other blend funds. So you can see there's a lot of options. One thing I do not like about Fidelity is they just have way too many mutual funds. It's overwhelming to go to their site. Over here on the right is the 401k plan I have from my employer. They also have target funds from 2025 up through 2065, also very heavily allocated to stocks in the 2065, probably a lower allocation to stocks in the 2025 versus what we saw in Vanguard. I built these funds and I created them a little bit unique versus the industry, but everyone's a little different, not so radically different that you need a financial planner to charge you a lot of money to do this for you. Everyone's strategies are going to be very, very similar. Low stock allocations for the 2025, high stock allocations for the 2065. So if you have a 401k plan, you can also use the target retirement as your one solution. I saw people where I worked that would have money in every one of the target retirement funds. If there were 10 of them, they'd put 10% in each one. That doesn't make sense. You should put all of your money in one, maybe two. Like if you're retiring in 2062, maybe you do a mix between the 2060 and the 2065. But there's no reason to have multiple allocation to these funds. You also don't want to have a target fund and a growth stock fund. Unless you have a lot of time for research of growth stocks or value stocks, you probably want to put all of your money in their target fund. These are the other options: growth stocks, value stocks, small cap stocks, global, international, fixed income. Very similar to what we talked about earlier in the videos about asset classes. The check marks just mean that's where I have my funds right now in this 401k plan. I have other funds outside of it, so you can allocate around your 401k if it doesn't have everything you need. You can use Fidelity and Vanguard to try to fill in the missing pieces. Now, what about the issue we talked about in an earlier video where these target funds, these mutual funds, tend to be allocated only to stocks and bonds. And as we saw in 2022, when you have inflation, those funds do horribly. The stocks are down and the bonds are down. So how do you protect yourself from inflation? And so there's two exchange traded funds that you can use. One has a ticker of GSG. Another one I saw, and there's others out there, I'm just giving you two examples, DBC. These are two funds that allocate to commodities like energy, like oil and gas, or agriculture, like sugar and orange juice, or metals like gold and silver. They tend to do better in inflationary environments. So if you are worried about inflation, you might want to put 10% of your portfolio into one of these exchange traded funds. You'd have to set up a brokerage account. I'll show you that here shortly. So maybe you want the Target 2060 fund, but maybe you'll put 90% of your money in that and the other 10% in one of these commodity funds. Now, which one do you pick? Well, it depends. The GSG is almost 60% in energy. The DBC is only 30% in energy. And you can really notice that in 2020 when oil prices and gasoline prices fell dramatically because everybody stopped driving, this fund was down almost 24%. In 2022, when firms like Exxon and Valero did extremely well because oil prices shot back up, especially with the Ukrainian war, they did extremely well, up 23%. The DBC was down in 2020, but not nearly as much, only down 7.8%. But in 2023, it was only up 18.8% versus 23. I am going to do the analysis. I haven't done it yet. I'll write a blog about it once I discover it. Traditionally, people wanted commodities like gold because the thought was gold would protect you from inflation. But gold did not do well in 2022. So I want to do analysis because I really do think there's a chance that oil prices have the better correlation to inflation. If you think back to our major inflation scares, 2022, the early 70s, it was very much driven by oil prices. Oil prices is a big part of our economy, and so when oil prices shoot up, we tend to have inflationary concerns. So I want to look at what would happen if you put your money in the GSG as a protection from inflation. Would it actually do better than the DBC? Obviously, in a year like 2020, it doesn't help you, but inflation was an issue there, and you're buying this for inflation protection. So remember, when you want to hedge something, you want low correlation. You want it to be going the opposite direction of everything else. And you want it to have some volatility. You want, when everything is down, like in 2022, when everything's down, you want it to be up a bunch to help protect you. And when everything's doing pretty well, in 2020, obviously stocks were down a bunch in March during COVID, but by the end of the year, they had done quite well. So you could afford to have 10% of your portfolio down a lot because the rest of your portfolio is probably doing well, especially both stocks and bonds did extremely well in 2020 by the end of the year. So maybe it is the better solution. I want to do some analysis, so if you're interested in that, watch for my future blogs and I'll probably talk about that. But there's a way you can enhance the target funds and make them better diversified than the traditional just stocks and bonds by placing some of your money into a commodity fund. Now, what about setting up a brokerage? If you want to do one of those exchange traded funds, just go to a brokerage site. Here I use Schwab, Charles Schwab, Ameritrade. Some people like to use Robinhood. If you're using Vanguard or Fidelity, most of them have some access to a broker. It might be easier to use a broker where you already have your mutual funds. It's so simple. just like with the mutual funds. You just go to their website and you look for the button that says set up your account and just follow their instructions. To do a brokerage, you do have to fund it with a few $1,000s. And once you have that built up, you can trade. And trust me, trading is very simple. Here's the trading page for Charles Schwab. They ask for the symbol. So if you were going to do the commodity index, you would put that symbol in here. And then you would tell them how much you want. It's very straightforward. You will see there are various ways to trade, but one of the options is a market trade, which just says, hey, just execute the order as fast as possible, whatever the current price is. There are other things like limit orders and stop loss orders. If you want to do more research and look into those, you can, but most retail investors, if you have not done an enormous amount of research, market order is what you want because that's what you want to do. You don't have information to make one of those other types of orders. Here's some exchange traded funds that you could invest in. I'm using iShares here. iShares is owned by BlackRock, which is the largest investment firm out there. You also have what's called Spiders, SPYDRS, that's owned by State Street. Vanguard has some exchange traded funds. They're called Vipers. Those are the three main ones, and you can probably just stick with them. If you go to some of the other firms, they do some exotic things that are pretty dangerous. There's some funds that have what they call leveraged equity, maybe 2 times or even 3 times. So if the stock market's up 10%, if they're 2 times levered, you'll be up 20%. Very dangerous if you don't know what you're doing. So you can probably just stick with iShares and Spiders and Vipers. They're all very similar and they work extremely well. So if you set up a brokerage account, that gives you the ability to do exchange traded funds. I am a big fan of exchange traded funds. I've gotten so that I like them more than mutual funds. I'm not sure how much the target funds are available as an exchange traded fund. Usually target funds are in your 401k plan or a mutual fund. So if you want to do a target fund, you're probably best off just buying the mutual fund. So again, if you went to Vanguard and bought their 2065 target retirement fund, you might put 90% of your money in there and then 10% maybe in a commodity ETF. You would have a very reasonable portfolio to get prepared for retirement. The exception I had was the person retiring in 2065 or 2070, where a lot of these target funds have 90% stocks, 10% bonds. There, I think I would just go to Vanguard and buy their all-stock fund. They have a global stock fund that you just buy stocks throughout the world. Maybe put 90% in there and 10% in a commodity fund or something more exotic. But generally, most of your workload can be handled by those target funds, and the ETFs, exchange traded funds, can just help manage some of the side risks that you want to address. So dollar cost averaging, let me end up with that. What do we mean by dollar cost averaging? It's quite simple. It just means set up your retirement so that you're spending or investing a set amount each month or every 2 weeks whenever you're paid. Have it come directly out of your payroll or directly out of your checking account. And by dollar cost averaging, what that means, sometimes you'll be buying stocks and bonds when the market is really expensive. And then when it crashes, you'll be buying stocks and bonds when it's cheap. But if you do that, averaging out over time, you will dollar cost average, so you'll have some high cost, low cost. It should average out to a really good strategy. That is usually the much better strategy for the typical retail investor versus the opposite of dollar cost averaging, which is trying to time the market. People who say, well, I'm going to wait until the market sells off and then I'll invest. What happens then a lot is the market keeps going up, and they're missing out on all these opportunities. And then the market crashes and then they're too scared to invest. So they just sit there not invested for year after year after year. Especially people in their 20s and 30s, just get in there and invest. It's the best way to invest. If you're buying these target funds, dollar cost averaging, they're somewhat doing that for you anyway. So over time, they're buying all these stocks as markets go up. They'll rebalance for you. So they'll prevent you from overpaying for stocks, because if stocks get too expensive, that's going to take your allocation from maybe 70% to 75% because stocks got so expensive, so they'll rebalance, get you back to 70. We'll talk more about rebalancing in a future video, but if you do the target funds, all of that's being done for you. So the next couple of videos, we're going to get real specific on some very intricate, almost complex, advanced topics. If you're going to stick with the target funds, those are topics that may not be of interest to you. But if you really want to get into this, sink into this, and become a more sophisticated investor, those will be interesting topics to address.